Glenn, everything going? I mean, happy to have you join us.
Yeah. Thank you for having me. It's been a while.
I mean, yeah, it's been a while, long time no speak. And you know, it's funny because I was one of my clients the other day sent me a post on Novo Nordisk, and I decided to read the post. Of course, when I opened the link, it led straight to your blog on your website, and I was like, oh shit. So you are reading the content that Glenn has been putting out, and I told her, look, I actually read a lot about that content, but about his content, and as a matter of fact, I met him already face to face on calls. So would you like me to bring him to the channel? Yeah. I actually asked that question. So yeah, one thing led to another, and now here you are. And I definitely appreciate the fact that you've been able to take some of your time to be here with us, and I'm pretty sure that you will provide a ton of value. Is there anything else you want to say before we crack on?
No, not really, but thanks for the person who read my blog. I'm happy she found it helpful, useful. So thanks to that. Yeah.
For sure. And by the way, so I will share your details, right? So your website and your blog details with my audience as well. So for those of you who are watching this, will be watching this video when we put it out. And if you are more interested in learning more about Glenn's work and how he goes about delivering a ton of value, then you will be able to find this information on that just by clicking that link. And I have to be fair, I just love it. And in fact, that was exactly how I stumbled upon Glenn's work initially. It was via his blog. So I remember, Glenn, not sure if you remember this, but initially it all started with Alibaba. I was reading one of your blogs on Alibaba. At the time, I was already an investor, so were you. And I actually left a comment, and I had no idea at the time that Glenn, like me, also had taken Phil Town's virtual transformational, as I call it, transformational workshop on investing. I think this is the perfect segue for my first question. So for people who are new to you, Glenn, into your work, how would you describe your investing philosophy?
Yeah, very much like yours, right? Because we took the same course, we read the same books, but of course it is long-term quality investing. Have a margin of safety when you invest, know what you're investing in, and quality companies who has a moat, which is very important. So everyone who knows your work probably knows my investment philosophy as well, because it's very much alike with yours. Yeah,
exactly. You know, and how do you think that was always the way you invested, or did you pivot your investing strategy over time as you went through certain materials, as you took Phil Town's 3-day virtual webinar? How did that change over time?
Yes, it changed. When I started to invest, I'm educated from Copenhagen Business School, so I know economics and so on, but I didn't have any experience in investing. So I just invested in Danish companies. You know, of course, Novo Nordisk was my first stock. I invested in all the other Danish companies, Maersk, Vestas, Ørsted, and I didn't even really know about much of their business. I had no competences in shipping or anything. Yeah, it was just because it was what I knew. So I just invested. So that was what I did. In what I knew the companies, I didn't really know that business. I didn't really know how to make money or anything like that. So that changed once I did the Phil Town course, because you have to focus on the server competence. So I pivoted away from companies I didn't understand to companies I do understand. So that changed.
Exactly. Yeah. Thanks for clarifying that. And today, yes, your strategy is quite similar to mine. We had the same, very similar foundation, if not the same. We believe in buying high quality businesses only with a margin of safety. And I have to, initially my journey was a bit different from yours, in the sense that I was actually trading as opposed to investing. At least I think you were already investing, but I wasn't doing that at all. It was not until I actually took his course and that's why I call it transformational, because once I started delving deeper into his materials, I was like, oh, so this is investing. Okay, we have to learn about what we put our money into. Doesn't that make sense? Okay, there are many different ways you can go about defining quality. How exactly, you mentioned quality investing.
Yes.
How exactly would you break that down? What's quality for you?
Yeah, for me, it is, first of all, it has a moat. It's the most important for me. So that protects it for competition. They need to have a high return of invested capital, something Phil Town is very vocal about. They need to have high margins. So these are things that, for me, define a quality company, I would say.
Yeah, exactly.
Of course, pricing power also. I like recurring and all predictable revenue, stuff like that.
Yeah. So when you look at the company for the first time, what's the very first thing that you try to understand? You mentioned quite a few things: margins, returns on capital, right? Whether they are good at allocating capital or not, revenue. What are some of the first things that you look at?
Well, the first thing I do is that I read about the company. What do they do? How do they make money? What markets are they in? And so on. Try to understand the company first of all. Once I have an understanding of the company, the first thing I look at, and maybe it's the same with you, I don't know, but the first numbers I look into is return on invested capital. It's always the first number I look into for some reason. Always. And I don't know why. It's just we learned that from Phil Town, right? It's always return on invested capital is the first number I look into. I look into margins. I like to see that the free cash flow per share grows over time. So that's something I get into. But first is the company. I read a lot about the company, both with the annual report, also on the websites and other analysis and so on to learn about the company. And then I delve into the numbers afterwards, starting with a return on invested capital.
We do exactly the same thing. And, you know, would you ever invest in a company that doesn't really interest you?
No, I don't think I would, because you need to be interested in company to keep up with it.
Exactly. I wanted to touch upon that. Exactly. And I keep preaching that because it's so important, and I don't see many people talking about that. Everybody talks about, for example, your circle of competence, the key numbers to look at. But starting from the very beginning, it's a very simple question. Man, are you at all interested in what they do? What are like these products, their services they sell? That is part of my initial screener, right? So when I go through a company, the first thing that I ask is, am I interested in what these guys are doing? And then do I understand how they generate money, how they make money, right? And I think what you said is so important, because if we are not interested in what this company are doing, how are we going to be able to, to catch up with them when they report earnings, for example, right? It's going to make our job much more challenging and boring. Would you agree?
Yeah, I totally agree. Also, just to keep up with the daily news and so on, if you're not interested in the company, you just don't follow it. So yes, I agree. It's very important. Also, it's not always possible. Also, when I like the product, it also makes a difference, right?
Yes.
So I think it's very important when you invest that you just don't invest in anything, because if you lose interest, how do you keep up with it? It becomes a task, and it should be fun, right? To invest also.
Yeah, I agree. Can we imagine going through the quarterly and annual reports and not liking the business model, right? Not feeling aligned with what these guys are doing? I can't even imagine that. It would be very, very hard. And so are there any business models or industries that you avoid altogether? Let's say it's a company that, falls within your circle of competence. Maybe you are interested in what they're doing, but how about all business models? Would you invest in every company, in every sector or industry? You want to tell me about that?
Yes, of course. there are some things I don't understand. So of course I don't invest in that. I try to read up on REITs. I don't understand it. I really don't understand real estate and so on. So I stay away from that. Also, it was funny when you mentioned before that you have to, how it is a task to read through the earnings call and so on, because I have a blog. So I have to write about different companies. Yeah. And one of them I write about is cybersecurity. And it just doesn't interest me. It is a task every time I have to update that blog post about that company, because I find it difficult. It doesn't interest me. I think it's boring. So I will never invest in a company who does cybersecurity, because it's just not my thing. But I have to do it because I try to write about different companies at my blog. But that's something I would never invest in, because I find it boring and dull, and I don't really understand it. Other things is like oil, shipping, all these kind of things. I don't understand. I told you that I had bought shares in Maersk, which is like a shipping company, but I don't understand shipping. I don't know why the rates are up and down or anything. So of course, that's something I avoid also.
Interesting. Yeah, and it's funny because cybersecurity, some of those companies have been, they have been performing tremendously well over the last several years, and especially now with the AI, with the advancements in the AI space. Chances are these companies will benefit a lot from that, because the need for cybersecurity is going to grow, right? But that's part of the reason, the same reason that stops you from investing in companies in the cybersecurity space stops me from investing in healthcare. It's the same very thing. We will touch more on Novo Nordisk, because I know you just mentioned that it was your first investment. Some of our viewers are also invested in Novo, but I keep telling them that the reason I didn't pull the trigger was because it didn't meet the meaning criteria, right? So, and even though everything was great on a quality basis, margin of safety, management, but the meaning, am I interested in healthcare? It's the healthcare as a industry that, oh man, I just feel boring. Yeah, so not for me. So thank you for clarifying that as well. And how would you say, so we talk a lot about competitive advantages, and how would you tell if a moat is real versus just a good story?
It's always difficult, right? Because there's some degree of, you cannot always be objective, I will say. But of course, one number to look at is the return of invested capital. Yeah. It always shows if it has high return of invested capital, it indicates that it has a high moat. So that's one thing. Of course, you can read about the company, the competitors, and so on. I think it's difficult because we all make mistakes, right? There's not like one answer, say, okay, this has a competitive moat for sure, unless it's a monopoly or something like that.
Yeah.
So it's always difficult, but if you should use a number, I would say it's always look at the margins, look at the return of invested capital. If that is high, it indicates it has high moat. But of course, you have to understand the business, you have to understand the competitors, and so on.
Yeah, that is essential. Yeah, I think it's hard for a business. When you look, for example, we're talking a lot about ROIs, return on invested capital. And if you go back, for example, and that's part of the reason why I'm not sure if this is the same as you, but I don't like to invest in companies that IPO'd, for example, in 2020. And we only have 4 or 5 years of financial data, because it makes very hard to discern how strong that moat is, because we don't have a long track record, right? And we typically like to see companies going through different phases of the business cycle, so we understand the resilience of the business model and all of that. But yeah, if a company has ROIs above 15% over 10 years, that tells you something, right? It means the business may have something. And okay, so you already told me that capital allocation, right, is very, very important. And how do you go about assessing management? Is there anything else you look at?
No, they have to look long term, never short term. And actually, I read this book. I'm sure you know it too. But
yes.
but that's a great book on how to assess management, I would say. But it's funny you mentioned it, because I think it was a couple of weeks ago, I updated my post about Heiko. I don't know if you know Heiko, the company. And for me, it's just the best management maybe out there, because they always think long term, always think of the shareholders. They don't care about quarterly earnings and so on. And for me, that is something that I like when I assess management. So that's how I think about it. So always think long term, and of course always have your shareholders in mind.
Yeah, and there are metrics that allow us to determine that as well, right? In the package, the compensation package, which is very, very important. So, for example, if these guys are being rewarded on a quarterly basis just to meet quarterly stock prices, that's a red flag.
Yeah, that's a red flag.
We want to make sure that they get compensated based on per share figures over long term to see if there is value creation at all.
Yes.
Yeah,
and of course, if they have like a large skin in the game, right? I'm invested in a small company called San Lorenzo. It's an Italian company who make yachts, like luxury yachts. And the owner there owns, I don't remember the exact number, but it's like 52% of the shares.
Wow.
So I know he's aligned with shareholders, right? So it's something I look into also. Are they aligned with shareholders? That's something I like too.
Man, that's so important for everybody watching this, because you said skin in the game, everybody. I think skin in the game is even if you didn't know anything about business, all stand equal, I think you would certainly make more money by investing in companies with with a lot of skin in the game. And this is because these companies historically tend to outperform the overall market. And I think there is a reason for that, right? Their incentives and ours are closely aligned. If the stock tumbles 20%, they will feel it because their wealth is going to come down, right?
Exactly.
So they want to make sure that they turn the ship around. Cool. So we discussed quality, some of the quality metrics. We touched upon circle of competence management. In terms of valuation, how do you think about paying up for quality? Because quality typically will trade at the premium, right? So how do you think about paying up for quality versus demanding that margin of safety?
Yeah, I mean, when I first started, after I took the workshop, I was all about margin of safety only.
Yeah.
Because it needs to be cheap. It needs to be very cheap before I buy. But I started to be more loose and pay up for quality now.
Okay.
And also, I remember, Warren Buffett did this, not to compare myself with Warren Buffett, but he did the same. And Charlie Munger said it's better to buy a fair price for a wonderful company than a wonderful price for a fair company, or how it was, something like that.
Yep.
And I think I started to move towards that. Also, I like Terry Smith, for instance.
Terry Smith.
He says the same thing, right? So I don't want to overpay, but I don't necessarily need like a 50% margin of safety when I buy a company if it's a quality company. So I started to also, because I lost out on a lot of opportunities back then, because I just had to have that margin of safety on 50%, like we was taught by Phil Town. So now I'm starting to be a little more loose on it and say, okay, I don't want to overpay, but if it's a quality company, I don't mind paying a little extra and hold it for a long time, of course.
Exactly, because history shows us as well, and this is something that Charlie Munger said, that if you pay a low multiple for a company that, for example, generates 7 or 8% ROIs, over time it's going to be harder for you to achieve better than a 7 or 8% on your money, right? But if you pay like a higher multiple for a company that generates ROIs around 15 or 20%, over time, your results will be closely aligned.
Exactly.
So, and we can see that as well. So, I understand that for sure, because in a market that is so expensive as the present one, on the whole, it's very tough finding companies trading at intrinsic value, let alone with a 50% margin of safety.
Yeah.
And I know that because I still demand a margin of safety in all my investments, and I know how hard it is to actually to find these gems in the market.
Yeah, especially if you look in the US, right?
Yes.
I think there's a little more value in Europe and also in China, Asia. Maybe, but especially in the US, it's difficult to find.
The US is difficult, agree. But it's fascinating because so many of its constituents have come down 50, 60%. And the index, the index like the S&P is only off 5, 6% of its all-time highs because it's largely driven by what the Mag 7 are doing, right?
Exactly. It's very concentrated on the Mag 7 right now. So you have many companies in the S&P who hasn't really moved the last many years are down, but because you have like these huge companies in the top, it doesn't really affect the index that many companies have not done that well. Do you think
this is dangerous? These high levels of concentration that we are seeing in the indices. Do you think this is dangerous for passive index investors?
I think so, because you think you are more diversified than you are.
Exactly.
So I think it's a bit dangerous right now because the S&P is not like it was like 10 years ago, right? It's much more concentrated on the top. So you're not as diversified as you once were.
Yeah, I agree. I couldn't agree more. And going back to the valuation that you were talking about as well, do you rely on specific valuation methods, or is it more of a range-based judgment?
No, I use the same calculations as you do, I would say, because of the Phil Town workshop. So we have like this, the margin of safety, the 10-app, the payback time price. So it's what I use to have like an idea of what I think a share should cost. And if people want, I have the calculator on my website. They're free, so people can just use them and plug in the numbers, and they will get a price also. But I still use it to get like a range of what I think a share should cost. Yeah.
Yeah, cool. Yeah, I do the same thing. Even though then I can always look at relative valuation metrics like price to operating cash flows, free cash flows, right? PE ratios. But I use that as well as part of just to give me like a range of intrinsic values, and I take it from there. Have you ever passed on a great business because it was too expensive? You touched upon that as well. How did you feel? Did you feel at the time compelled to actually buy it, or you actually hold off? How exactly?
Yeah, I've missed opportunities. I remember it's not many years ago that Amazon was trading below 100, right?
Yeah.
I was down to 90, and I didn't buy it. And I still kick my shins about it every day because that was just stupid, because it didn't reach the price I wanted to pay.
Okay.
So that's something that comes to mind now. It was Amazon because it's a business you understand. Well, I understand, I would say. It's a great business. It was just trading a little above what I wanted to pay. And that's, then I didn't buy it. And so that's one I missed, I would say.
And now a funny question here. What's one investing mistake that taught you the most? Was missing out on great opportunities like the ones you described, or was it something else?
No, also something else. I have also made the mistakes where I bought something I shouldn't buy. Not because it was too expensive, but maybe I didn't have the idea of the business that I thought I had. I remember one of the first stocks I bought, that was a Chinese stock. It's called Hello Group now. It was called Momo back then. And that's like
I know Momo.
You know Momo, like the
yes.
Chinese Tinder or something like that. And I bought it because it looked very cheap. They had high margins and so on. So I thought about it. But ever since then, I've sold it a long time ago. But it just went down and down and down because obviously no one is using the Chinese Tinder during lockdown in China. So, and I don't know why I bought it. I thought it was cheap and I was intrigued. So I sold at a loss, and it's even lower now than what I sold it at. But that's a mistake I made. I remember I was intrigued because, okay, it's very, very cheap and so on. But yeah, so that was one mistake I remember I did.
There's a very important lesson there. I think just because something is cheap does not mean it can't get any cheaper.
Exactly.
And this is it, right? So we have to, when we buy something with a big margin of safety, and I keep telling this to the people that I'm working with, is you have to understand whether the moat has been permanently breached, right, disrupted or not. If the business has been structurally impaired, then buying with a 50-70% margin of safety makes little difference, because likelihood the company is going to go down.
Exactly.
Yeah, right.
Exactly.
So yeah, this comes back to then understanding what we were describing initially, the moat. Do I understand the moat? In what you've been doing investing for a while. So what situations still test your emotions as an investor?
Well, now we talked about Novo Nordisk earlier, right? So man, it seems like no matter what news they come with, it just drops like 20% in a day. So that, of course, it tests my emotions. I still hold it, and also I buy because I believe in the long term. But it's tough. I mean, February was the worst month ever for Novo Nordisk since it was listed. Ever.
Wow.
So and I mean they just launched maybe the best launch ever of any drug with the pill, and yet it had the worst month ever in its history of a listing. So something like that, of course, I think everyone gets tested when that happens. It just drops, and you feel like the bad news comes all the time. Another thing, I don't know if you were investing in Alibaba back then, but like in the end of 2020, when the Chinese start to make some regulations and so on,
yeah,
you feel like
crashed.
Every day something happened that was bad for Alibaba. And it cannot continue. And there's nothing you can do because it's like political and stuff like that. So like, I remember I felt like it was like every day there was some bad news on Alibaba, and there's nothing you can do. You can sell, or you just have to ignore it if you believe in the case. So something like that tests my emotions, because I think it does for everyone. But the important thing is not to react to it. I mean, you should not react when you're emotional. Then think about it and then react afterwards. But of course, it's tough for everyone. No one likes to see its position drop 20% a day. No one likes that.
I mean, this is awesome. And I think what you just said is so important, like controlling your emotions, even in the face of adversity. So, Glenn, you live in Denmark, so probably many people who are working at Novo. And because in my audience, I have people invested in Novo Nordisk, and some of them are clients. Based on my due diligence, I think the moat is still there. And so even though the stock is coming down, I still believe the company has a moat. I still believe they operate in a duopoly. And I believe, based on what you're just telling me, correct me if I'm wrong, that's also part of the reason why you haven't sold the stock. Is this correct? Yes. What do you think about the company right now?
Yes, it's correct. I haven't sold anything. In fact, I've been buying lately because it is very cheap. Of course, right now it's because the guidance is very low. The thing is because they lower the price, and the CEO have said many times, once you lower the price, you feel the impact right away. They lower the price to build volume. Volume takes time to build. So that's why it dropped now. It's because they have lowered the price on the drugs, and it takes time to build up volume. And right now, people think it's like the obesity mice, the winner takes it all. They think Eli Lilly will take it all, or competitors will come in with generics and so on, which they will. But people fail to understand that right now there's a few million people in the world treated for obesity, and there are 1 billion people that are obese. There'll be no winner takes all. There's no drug that works for everyone. There will be many players in the market. There's room for everyone. And this is an ongoing treatment. It's not like you take a pill and you never have to take a pill anymore. Or you take an injection and never have to take an injection anymore. It's ongoing. So I don't worry about Novo. It will not be an easy year, 2026. But in the long term, I mean, they also have a pipeline. They've done this for decades. I mean, the company is more than a century old. They have done, it's not like they suddenly forgot how to develop drugs or anything. So I think with some patience, I think it will be all right.
I think this, yeah, and I thank you for sharing that. You know, what I understand from what you're just saying is, again, you are not making, you are not basing your decision to hold on to the shares based on what you are seeing on the headlines, right? Because in fact, otherwise you would be doing exactly the opposite. You would be selling out of your stock right now. But because you understand the company, you understand its competitive advantages, you understood that even before you invested in the company, and so this allows you to build conviction in your thesis. And this is exactly what I try to convey to other people as well, is that even though nobody likes to see their portfolio going down, this is perfectly normal. And provided the more we understand about the business, I think the more comfortable we will be. Do you agree?
Yes, I agree. And yes, I agree. And it's true what you said. So, I mean, it's not fun, but I'm not like worried or sleep bad at night or anything like that because my position is down. It's just what it is right now. I think in the long term, I still think it will be a good investment. And right now, it's not my thing, but right now you also get like 5% in dividends if you buy right now. So, I mean, I think it's all right. So it doesn't really worry me. Of course, I would like my position to be up, not down. But what can I do? In the long term, I think it will be just fine. That's what I believe, and that's why I've been buying more as it drops.
Awesome. Moving on to portfolio construction and long-term execution, Glenn, initially before this call, you were telling me that you have about 17 companies in your portfolio.
Yes.
How do you have? Is there enough diversification for you? Is it a fully invested portfolio, or how do you feel about that? How do you feel about concentration versus diversification? Let's start with that.
No, I think as a private investor, you need to have concentration to some degree. Okay. Because if you're too diversified, you might as well just buy an index fund and then stick with that. So I think you need some sort of concentration. If it's a 10, it's a 20, I don't know. But I don't think it should be much more than 20 stocks, in my opinion. Okay. I have 17 stocks right now, which is a little too much. Actually, I would like to be below 15. But also, as I told you initially, the reason I have so many are for different reasons. First of all, I have many small positions because I bought them when they dropped and they increased afterwards. So I haven't been able to increase my position, like Copart, which features in one of your videos. I bought it just when it dropped after earnings. But since then, they have risen like 10%. So I haven't been able to increase it. Other reasons are I have like Microsoft, it's a small position now because I sold half of it. It have increased 200% since I bought it, so I sold half, and now it's house money. And I thought, okay, I might as well hold on to it. Even though it's a small position now, but I see no reason to sell it because it's a quality company, and I already got my money back and more. And then finally, this is hard to translate into English, but in Danish we have a saying like we call it a stamp. You can buy a stamp in a company. It's like a very small position in a company that have it can grow a lot. I can go bankrupt more, so to speak. Yeah. So I have also a few stamps, so to speak, very small positions in some companies. I think okay, if they succeed in what they're doing, this can be a major win. Else they might not turn into anything, and that's fine because it's very little position.
Yeah. You mentioned another thing very important, and this is something that, the other day I was talking to somebody and he was telling me, look, I bought this company and made it immediately 30% of my portfolio with one purchase. So I wouldn't do that because, and neither would you, because what you do is you determine, okay, so we will start the position, but then what happens if the company becomes cheaper provided the thesis hasn't changed, you will add more to it. But if you buy the entire position all in one go, then you are out of firepower. Do you do the same thing? So you start small and then you increase your position as it gets cheaper or remains range bound?
Yes, I always do. Also because I'm bad at timing. I don't think I can type the button normally. So I always buy a small position and then I average down. And it can be if it drops, it depends. Sometimes like if it drops 5% more, I buy more or something like that. It depends. But I always average down usually when I initiate a position. So that's why I have so many, because I have many small positions now, because for some reason I've been lucky enough to buy that button, which I didn't expect. But the goal is always to buy a small position and average down as it drops. That's how I like to do it, and not go all in on a position right away. Exactly.
And let's say one or two of your holdings are by far the best performers. What determines how big a position they would become over time? So at one point, I believe you might feel uncomfortable leaving your winners run, right? So, okay, let your winners run. But let's say if at one point 40 or 30% of your portfolio is in a single company because it's been such an amazing performer, would you trim? Would you sell? How would you balance that?
I usually trim. I used to trim like I did with Microsoft, for instance. I trimmed it. That's what I like, because I don't want my portfolio to have like a percentage that's like 50%.
Yeah,
that's too concentrated for my taste. So I usually trim when it gets over a certain percentage of the portfolio. I usually trim it a little bit. It also depends on what my initial size is and so on. So I don't have a fixed number, but usually I trim it when it's up like, it depends on the company and so on. But I trim it. I trim it along the way. Sometimes I sell it all if I feel like it, but that's very rare. Usually I trim it. And that's also why my portfolio is at 17 stocks right now, because I have some positions I've trimmed, and then I say, okay, it's house money now, I let them run. And I don't plan to add more to that position.
So, Glenn, if someone is early in their investing journey, as we were when we started, what's the one habit they should focus on first? What would you say to your younger self?
Always understand the business first of all. What are you investing in? Don't follow social media. I mean, if you go to like X or something like that, it's always the same companies that are like promoted for some reason. I don't know why. Don't just buy a company because someone tells you to buy it. Always do your own research, do your due diligence, and only invest in things you understand. You will make mistakes. Everyone does. Everyone buys a stock too expensive or anything like that. Just as how it is. But as long as you do your own research and you have an idea of valuation, I think you'll do fine.
What's one mistake? If you could pick one, what's the most important mistake that the vast majority of investors still repeat?
FOMO,
fear of missing out.
Yeah, I think that's a big mistake. People hear about a stock all the time on social media, then they FOMO into it for no reason. It could be FOMO can come from different things. Like you remember GameStop? What's called
GameStok. GameStok. There was another one. Well, at the time we had Robinhood as well.
Robinhood.
There's another one. AMD.
Yeah, maybe.
Something like that.
There are different ones, and you like FOMO into it, and you end up holding the bag because there's no value in this company, but you just hope. Well, it's called the great idiot theory, right? You hope there's a big idiot than you that buys it, even though there's no value in it. And I think FOMO is very, very, you have to be careful with it because it's easy to be talked into. And see the greatness of a company. You see people make a lot of money in a very short amount of time. And you think, okay, if they can do it, I can do it too. But it can end very bad. So I'll say be aware of FOMO.
I think we've all been a victim at some point in our lives. That was certainly my case. But then I learned from my mistakes, but also as I became more mature as an investor, and I was able to stay away from it, right? And so, just one last question for you: are there any investing books that changed the game for you, or in other words, is there any books? What books would you recommend reading?
Yeah, that's quite a lot of books. Of course, we have the books of Phil Town. I think we both read all three of them. But actually, I prepared a little bit. I didn't know you would ask me this, but I still prepared some books. But I would say one book lately, and this is a recommendation I've been reading that I really like. It's called The Compounders.
I don't know that one.
No,
The Compounders. Okay.
I think they are from Norway. The people who Norway. They are from Norway, and they wrote about serial acquirers like Lifco and Heiko and so on. And for me, it's opened my eyes to these businesses. So I will recommend for everyone if they want a new investment book, buy The Compounders, and you can see the names there. I can pronounce it, but I don't know. It's called Oddbjørn Dybvad, Kjetil Nyland, and Adnan Hatzifenich, I think. But for me, that's a great investment book if you want something contemporary. Because of course, the Phil Town books I always recommend them because it was what started my investment journey. And all three of them. I started with Rule 1, probably you did too. I went to payback time, and then in what's called investing, the last one he wrote with his daughter, and those three are must read, I would say.
Yeah, I agree, and they are actually they present these philosophies in a very simple way, concise and simple way. So it's easy for people who are just getting started to actually understand how this thing or value investing works and what to look for. Glenn, thank you so much for joining us right here. Is there anything that you want to say? I will be sharing the links for your blog in the description, so anybody watching this can have access to more of Glenn's work, because I definitely recommend it. I love it, and I think it's so insightful, and it will definitely help you become better investors. Anything else you would like to say, Glenn?
No, thank you first of all, but no, and my blog is free, so people can just read it. I'm not always good at updating the post. I try, but it's a lot of work, so have patience with me. But yeah, read it, and it's free, and do your own research. Don't buy a share because I tell you to do so. You should do your own research. Use it as an inspiration. That's what I will say. Yeah.
Thank you so much, Glenn, once again, and I'll speak to you soon. Thank you.
Thank you.